appreciate you joining. And what I'm going to do is walk through kind of how I approach due diligence and how accredited investors can do it. So for those that don't know me, Gary, you do know me. My background is I've been a real estate investor since 2006. So I started doing single family properties. I flipped a couple dozen. I've owned up to 18 single family properties. And over the time, I've learned a lot about sourcing deals, marketing for deals, finding, qualifying, operating, financing, both private and bank capital, and so forth. I also worked as a commercial underwriter for a New York City hedge fund and underwrote hundreds of deals in that time period, multifamily, retail, office, hotel, even an airport. Right now, I co-own 702 units as an LP, valued at 68 million, and 94 units as a GP, a general partner, here in Kansas City. The other units, the 702, are scattered between Kansas City and Lexington, Kentucky. So it can be done out of state, and that's one of the exciting things about this type of investment. So what I'll do is I'll walk through kind of an introduction about what due diligence is and how to think about it. So I will go deep in 4 different areas, just one slide for each, but I will talk about those at length. And then I will come back and provide a quick tip. So for the accredited investor that doesn't have time to do all this all this due diligence, we'll be able to go back then and give you just kind of a high level view of what you can expect if you're an accredited investor, how to get through some of this stuff a lot more quickly. Along the way, if someone does have a question that they'd like to ask along the way, then certainly you can put it in the chat. And aside from that, then I'll get to the questions at the end. Okay. All right. So when I think about what due diligence is, it's a fancy term, but it's really kind of caveat emptor, let the buyer beware. It's about doing a systematic process to do research on an investment to make sure that it makes sense for you, your goals, and that the risks are mitigated as much as possible. So there's a number of things that we go through, and I'll talk about 4 of them here today. The physical piece of due diligence, the financial pieces of due diligence, the legal pieces, and then lease audit checks, which is an important part to validate that the people in the units really actually exist and that there's good alignment there. So, the important reason for multifamily real estate, as well as any other type of investment, is just doing your homework makes you feel comfortable about it, makes you confident that the decision that you're making is good. Because with multifamily, you're investing typically $50,000 or more. And so it's not small change. And in some cases, investors are putting millions into these deals. So doing the homework up front is especially important. The other thing is, multifamily, people understand it pretty well in concept, apartment buildings, apartment complexes, but there are real people's lives that are involved in a multifamily project. And so doing the due diligence also makes sure that the operator and the sponsor has their priorities straight, that they have it set up, and that you're comfortable with that as an investment and as a co-owner. At the end of the day, all of this is about mitigating risk. Doing your homework, like anything else. You buy a car, you do research on it. You buy your own personal residence, you do research on it. And so you're really looking for those types of things and opportunities to identify where are the risks. Are they being managed appropriately? It will never be risk-free. No investment is risk-free. But doing this type of homework can really make a big difference for you. So in terms of physical due diligence, think of this as walking the property with an experienced eye. So they will do a property inspection, typically the people that are buying the property. And as an investor, we'll talk later about getting to know the sponsor or the operator of the property. But walking the property is important. You're looking for, if you can look at it in person, you're looking at things that you would normally see without even being a trained eye. So is the foundation cracked and crumbling? Are the walls kind of leaning? Is there a sag in the roof line? Do you see deterioration around the windows? Are the windows frosted and damaged? Is the brickwork cracking that needs tuck pointing? A lot of this you can just look at and you will know just intuitively if there are issues. If there is something that you feel is structurally a concern, without being a professional engineer, you can hire an engineer to do that, right? So the structural issues is an important part of that, and maintenance needs that you see. So it's not always things that are broken, things that are rotting. It could just be, are the carpets in the common areas clean? How does it smell? What does the leasing office look like? Are the grounds in good shape? Is there garbage on the ground? Are the garbage cans emptied? Is the grass mowed? All of those things require care and feeding, and making sure that that's either in a good place or will get to a good place is an important part. Now, one thing to keep in mind is with value add properties, those are deals where they might not look so good, right? In fact, they may look pretty darn ugly. But it's really understanding the operator's strategy, the sponsor's strategy, and what they're going to do with that property to fix it up and put it in a position that works. If there are major structural issues, then that needs to be accounted for in the financials. And when you look at the financial underwriting, it needs to be in there. It needs to be accounted for. So that will be really important. Environmental concerns typically are not a big issue for multifamily properties, but this is where if the property is located next to, say, for example, a gas station or a cleaners or a construction site or something like that, where there could be runoff, there could be leaching of chemicals under the ground. If it leaches under the ground and it's underneath that property, now that's an issue for you as the property owner, even if it did come from a gas station. So walking the property is not just the property itself, but what's immediately around it that could be a concern. If there are pipelines that are running nearby, that could be something that might be a concern. So those are things that you wouldn't be doing the work on as an accredited investor, but there's certainly something you want to ask about to see what the risks are and how that's being taken care of. The repair costs are not, they're really for the operator and the person that owns the property all the way through. If you're an accredited investor and you were buying it on your own, you certainly would need to do that. And my guess is you would have someone that helps you with it. However, as you get that sense of the property and what it looks like, is it a big dollar amount? Is it a smaller dollar amount? And that's where when you interview the sponsor or the operator, you'll want to really dig into that a little bit more to have a good understanding of it and how that stacks up. One of the biggest reasons that multifamily deals don't work out is the operator runs out of cash. And that's because they didn't estimate the repair costs appropriately. They had overly optimistic vacancy rates and how fast they can fill it, how much they can increase rents and so forth. We'll talk about that in a little bit. But the repair cost piece is certainly a part that burns through capital very fast at the beginning of the project. So they have to have enough to carry them through. The financial due diligence is really where you as an investor take a lot of your interest, right? And when we work through our deals that we take down, we're looking at all of these different things. So the income statement versus the rent rolls. A rent roll is basically an Excel spreadsheet that lists off who all the tenants are, when their lease starts, when it ends, what their rent is that they're contracted with, and what their deposit is. Sometimes those reports will also have what's the market rent. So for example, in a property, if they're paying $900 a month for a particular unit, it may be that in that market, they could actually get $1,100, right? Because that's the market rent and that's the value that you're looking to see. But reviewing the income statement, the rent rolls, they need to line up, right? If you have 100 units pulling $900 a month, then you should be looking for that $90,000 a month coming in on the income statement. And if it doesn't match up or it's off by an X factor, then that's really a concern. Comps is something that's a little bit different with multifamily than you would have with a single family home. In a single family home, they'll look at all the properties in the neighborhood. What are they selling for? They compare the features and square footage and bedrooms and baths, and they adjust that based on how they sell. With multifamily properties, it's based on the net operating income or how much cash it's producing. And there's a formula using a thing called a cap rate, which values the property. So it's very much financially based. However, an appraiser and an underwriter at a bank will look at the physical nature of the property and what similar properties sell for in the area. So there is a little bit of the comparison to sales prices in the areas, typically expressed in terms of dollars per door. So let's say $70,000 per door, per unit. Maybe a comp that they see in that area for similar classes. But there are so many variabilities in terms of the income that comes off the property, that the income off the property is the prevailing reason that they use in the valuation there. The operating expenses is also interesting. An older property is going to have higher operating expenses and is typically expressed as a percentage of the revenue. So if your total revenue is a certain number, those operating expenses can range anywhere from 30% to 75% of that top line number. Older properties with a lot of turnover, bad tenants, a lot of vacancy, could have very high operating expenses, which hurts the value of the property. Brand new construction that's getting top dollar rents, there really aren't capital expenditures. There's very low maintenance and repairs. So that could be in the 30s or 40s percent in terms of the operating expenses. So this is where the comps and working with a really good realtor or broker in that market can help you make sure that those line up. However, I will say that the listing broker has an interest in selling the property for a maximum price. So it is important that as an accredited investor, you're looking at what is really going on in that market and work with the buyer, the operator, the sponsor is another word for that, to see what they see about it and make sure that it makes sense for that market. The cash flow projections is where you need to understand their strategy. So if this is buy something that's in disrepair, undervalued, half vacant, the cash flow projection is going to be a dramatic climb over the period of that ownership. So it may start out with a negative number where it's losing money every month. Then you're putting in a lot of capital expenditures to fix it up, improve the units, market and get tenants in there. There may be discounts to get them in, but your cash flow will improve over time and get to the point where what they call the stabilized value comes in. When it's stabilized, it means that it's at about 90 to 95% vacancy, it's at market rents, and it's where you're trying to get it to. So if the cash flow projections are in a value add model, you may see it on this steep climb. However, if you're buying an already stabilized asset and you're just interested in straight cash flow, so in other words, it's already full, it's already at market rent, you just want the paychecks every month, the mailbox money, then the cash flow projections will be very steady Eddie. They may go down a little bit with capital expenditures, but it's a very different type of investment. Your returns will be less, but the returns will be less risky and more consistent. So it's all about risk and return. The capitalization rate is a way that property appraisers use to value a property. So a capitalization rate is expressed as a percentage that's compared to the income coming off the property. And they'll usually use terms like 4 cap, 5 cap, 6 cap, 7 cap, that type of thing, which is 9%. If you take the income coming off the property divided by that 9%, now you get the value of the property. So the capitalization rates, cap rates are really important, and understanding what makes the most sense. One thing that I see in underwriting that happens a lot is when someone is promoting an investment, they tend to be overly optimistic on the cap rates. They may say, oh, we can sell this for a 4.5 cap, which is a much more favorable cap rate. But in that market, it may be 5.5 or 6 caps. So they want to see the numbers look prettier to attract investors. is part of your job as an accredited investor to make sure that those cap rates line up with what the experience is for that asset class in that market. The last thing then is on financing options. There's different pieces in what we call the capital stack, and in order, it's typically bank debt is in first position. So this would be a traditional bank, traditional loan. Then there may be something called mezzanine debt, which is a second position loan, still paid current. It needs to be paid all along the way. And then you start to bring in equity investors typically after that. And there could be preferred, Class A, Class B. There's a whole structure of equity investors that come into it. Each person is further away from being the first to be paid, but the returns also go up for those investors to accommodate for that risk. So, for example, a bank loan may charge 7-8% on their note. So it's the lowest return, but they are first in line. They get paid first. A Class B investor may have an 8% preferred return plus a share of the equity. And with that, they have a much higher potential return. 14, 15, 16% is not uncommon. So there is that payoff for that. The financing options has a big impact on the way that those play out and the formulas that go into it. So the more that you have in that capital stack, it can make it more complex, but it could be a way to tweak those different things to make sure that it's delivering the optimal return to you. Okay, in terms of legal due diligence, there are some documents that come through. The leases, contracts, this is all typically done by an attorney. Unless you're an attorney yourself, as an accredited investor, I don't want to take on that responsibility. But it's really making sure that, the property is titled in the appropriate way, that there isn't any clauses in the contract that are out of whack that could inhibit the sale, inhibit the transfer of title, or anything like that. Potential liabilities could be lawsuits or liens that are filed against the property owner that can prevent the sale from going through. So part of it is making sure, and the attorney can do this for you, doing the search, and the title company as well, to make sure that there are no unusual liabilities pending against that property. Because think about it, if it's a 200-unit property, that could be 200, 300, 400 people that are all living there, which leaves lots of opportunity for lawsuits and potential issues. So you need to be careful of that. Zoning compliance is typically not an issue for an existing multifamily. It's already been zoned, it's built. There's not usually an issue there. However, if it's new development, that's where the zoning can be a pretty significant factor. It's not uncommon now you see a lot of building going on in the different areas because there just isn't enough multifamily apartments around. So because of that, the zoning needs to be put in place. An example would be an investor friend of mine who did invest in a development deal, and a number of investors put money into it. They were told about the development cycle and how it was going to work. They were going to build a subdivision of homes, all built for rent. And they found out later that this operator, the sponsor, had never done a deal like this before. And they had no zoning in place. They had no permitting in place. And then the land just sat. So it was hard for them to get out of that. They did ultimately sell it. People did get their money back, but there was no gain, right? So the zoning compliance can be an issue, especially for new development. Insurance is a really big deal nowadays. The cost for insurance has gone up a lot over just the last year because of a number of factors that you can read about in the news. But insurance is all over the place now. So the best thing to do there is reach out to an insurance professional to get their opinion on the offering that's sent to you. So you would more than likely, as an accredited investor, would not have that level of knowledge, but being able to go through it and with a professional, they can validate if the insurance costs are in the right ballpark, then you can always work with the operator there as well. Okay, the last part is in the 4 areas is really the lease audit check. And this is important because if you have a non-professional property manager, they may just let people live there for a while and they might not have a lease in place or they might not renew the lease. If you look through the lease agreements and find out that the people aren't who they say they are, or they haven't had the proper background checks, or that they are not paying on time, or there's a discrepancies, that has a big impact on the ability of the financing to go through. Because you better believe that that bank underwriter is going to do this exact same work. And if he sees this and sees these people don't really live there, it doesn't line up with real people information, they're not paying on time, they will write off those leases, and then it looks like you're at a much more vacant property and the deal might not close. So really going through the accuracy of the rent rolls and the leases, and it does require, if you really do it right, it's looking at every single lease that everyone has signed. Now, what I recommend is, as an accredited investor, because you're the investor, you don't want to spend the time doing that. That's where you're looking for the operator, the sponsor, the buyer to be the one that provides that information for you to make sure that it's all valid. Okay, so if you don't have time to do all of that and you don't have the desire to do all of it, the first thing that I recommend investors do is interview the sponsor. I've also used the term operator, I've used the term buyer. Really talk them through, and there's a whole checklist of things to ask a sponsor. If you're interested in that, you can let me know. Reach out to me on LinkedIn, and I'll be glad to send you a checklist to ask. But that becomes really important. So you're asking them about their experience, types of properties they've done, when a deal has gone bad, if it has, how do they handle it? Do they ever have to do a capital call? A number of questions, right? At the end of the day, a great operator can save a bad deal. A bad operator can kill a good deal. So really knowing that sponsor and having confidence in them is absolutely critical. The other thing is to think about the key areas based on what it is that you're finding, right? So for example, if you are most concerned about consistency in cash flow, maybe one of those value add deals is not your cup of tea, or maybe a ground up development deal is not appropriate for you. So it's really based on the things that are most important to you. You can hone in on those areas and then just interview the operator for the rest. If you do need to hire specialized services, I always recommend get a professional. Very often the broker can help you with that. If you have a buying broker helping you with it, that can also help, property inspector, appraiser, and so forth. You do have a right to see the appraisal if you're an investor in that, a potential investor in that deal. So if an appraisal is done, you can reach out to the operator and get a copy of that, and that will help validate some of the things that you'd like to know. Leveraging technology is using things like CoStar, Reonomy. There are Crexi. There are a number of commercial real estate information sources that you can quickly search an area and get comps and get rents in the area, can get the other properties that have sold. You look at mortgage information. A lot of that information is there. Now, it's not inexpensive to have those. So if you are doing investments at scale, you could do that. You can also work with a broker that you appreciate working with and make sure they're taken care of, and they can probably do this as well. Okay. The other thing is, networking with industry peers and other people that have done this. Just ask. Find out what it is that they do and how it works. There's a lot that can be learned just by asking questions of people that have been there before. The last two kind of go together. The things that are most important to you are the things that you'd want to focus on, and compare that to your goals. A development deal is higher risk, higher return. Are you comfortable with that? Not seeing any payout for 2 or 3 years before you see a payout? Maybe that's appropriate for you. If it's not, then you pass on that deal. But looking at all those different items become different, right? There aren't rent rolls on a development deal. But there are in a stabilized deal. So all of those things vary depending on what it is that you're looking for. Okay, so just kind of rolling it up, there's the four areas that you go through when you're looking at the due diligence here. There are some investors that can do this in 10 minutes because they know it's important to them. They know what they're looking for. They've done this many times, and they can decide literally in 10 minutes if they want to invest in the deal. It can also be 10 days, right? Really digging in, talking to the operator multiple times, figuring it out. It's all about managing your risk and understanding the risks that you're getting into, what the ups and downs are, and making sure that that's comfortable for you. Knowing that sponsor and operator is really important. All of this is about making sure that you're being strategic with your goals, but also being cautious to make sure that you're very comfortable with this, because this is your hard-earned money you're investing, and you want to make sure that it's being applied in something that you feel comfortable with. Okay, so if you have any questions, I'd be open to hearing them. Any questions? I do see someone sent one just to me. What should I think about if I live out of town? And that's a good question because, like, for example, my LP investments in Kentucky, I did not see those properties when I made the investment in those. What I did is I did my own kind of financial comparison with what I knew about that market. I did talk to the operator at length and asked many questions to make sure that I was comfortable with it. I really looked at their track record as well. That particular sponsor and operator has done numerous deals just like the one that I had invested in. So a lot of it was based on those interviews that I had with them, and I got to the point where I was comfortable. At the end of the day, you shouldn't invest more than, let's say, 10% of your net worth in any single investment. That's the guideline that I use. So once I had gone through that, I felt comfortable investing that 10% in that deal. Okay, how are returns calculated in commercial real estate and MFA? Is it PK, commercial real estate, MFA? What do you mean MFA? If you can clarify that, PK. Multifamily apartments, okay. Returns are calculated typically in three ways. The first is called internal rate of return, which is the money that you put in, which is expressed as a negative number. You invest $100,000, that's negative 100,000. And then each year there's some type of returns that come off of it. It's a combination of all sources. So it could be cash flow, it could be an equity gain, it could be the sale proceeds and all that, a preferred return along the way. So internal rate of return is that string of cash flows, negative at the beginning when you invest, that's the amount that goes in, and all the positives, and it calculates a percent. So with multifamily, it's not uncommon for it to be 13 to 18%, called IRR. Another one is called the equity. Yeah. Yes, I can provide a typical example of IRR with numbers. If you reach out to me after this, then I can look for that. So an example would be if you invest $100,000 at the beginning, then as it progresses, it might be in the first year, there's nothing that comes back. The second year, maybe 2,000, 5,000, 7,000, somewhere in that range, just cash flow. Then there may be a refinance event that happens where now you gain $20,000, $30,000. And then at the sale, you may gain $80,000. So the capital events are the biggest returns. The cash flows typically are much more modest. And that's where the IRR gets its biggest boost, is in the equity at the end. If you're investing in a stabilized asset, then it may be a consistent amount at each point along the year. Okay, so getting back to the question about if you're out of town, so one of the things that you can think about there is talking to the operator, interviewing them really well, and then seeing that. Oh, one other thing that we look at is equity multiple, or sometimes we call it EM. Equity multiple is for the amount that you put in, how much will it multiply at the end of the project? So for example, it's not uncommon for multifamily to have a 2x equity multiple at the end of that period. So you put in 100,000 and your total profits at the end are 200,000, plus you get your original 100,000 back. So that 200,000 profit is a 2x equity multiple. You have gotten a double return on the money that you put back in. So an equity multiple of 1.8 to 2x is not uncommon. Okay. Yes. So do you get tax advantages for depreciation as well? Yes, you do. That's one of the huge benefits of investing as an LP. There's a number of benefits, but one of them is that you do get that proportional depreciation. So it's not uncommon to have, it could be on paper, a loss at the end of that period. You do get a 10K just like you would with any other major investment, but because of depreciation, you can take that off of it. So if you picture putting $100,000 in an ETF and it produces, let's say, 10% a year, you're paying taxes on all those gains, right? There's no depreciation tax advantage. LP investments, limited partner investments do have those advantages. So thanks for the question, PK. Okay, so what I'd like to do is anyone that's interesting, yes, you can use an LLC for the investment. Absolutely. What I'd like you to do is for anyone that's on this call that would like to learn more, please reach out to me. My email address is here. The recording will be released. And then also I encourage you to go to our investor portal and join the club. What that allows me to do is reach out to you. We can have a conversation one-on-one. And you can also provide information about what your experience is. And that allows me to send you opportunities as they come through. So the example, the deal that we just closed on a couple of weeks ago, as an investor, you would get first look at those opportunities to invest. So yeah, PK, I'd love it if you reached out to me. Anyone else on this call, please reach out to me in that portal. And then I'll be happy to connect with you. And on that note, I really thank you all for joining. Really appreciate the time that you spent. Please reach out to me with other questions. I'm happy to help. I definitely love helping people achieve financial freedom through real estate. I'm a huge believer in it. It's benefited my family immeasurably, and I'd like to help you do just the same. Okay, thank you very much. I appreciate you all joining. You take care and have a great holiday season.
Thank you.
Thanks, Jim.
Okay, bye-bye.